Well, I think value investing has evolved dramatically. I mean, if you go back to Graham and Dodd, and it was net and hard book value and things of that nature, and then we got into low price earnings multiple type investing for a number of years, which was backed by the Intelligent Investor in Ben Graham's second book. And then Warren, introduced us to the idea of cash flows, that we ought to be paying attention more to the cash, not the accounting numbers, the economic numbers. And so people that latched on to understanding cash flows, I think, got a leg up on it, if you will, began to do a little bit better than those that were just doing accounting metrics. And then both Warren and Bill Miller together began to emphasize if you had two equal cash flows, but one had a higher return on capital than the other, the one with the higher return on capital would be more valuable. And so, you began to merge cash flows and return on invested capital together. But I think the real challenge that I faced and what I was so excited to do was take Warren Buffett, and I didn't really want to sit and buy Warren Buffett stocks. I wanted to take the methodology and move it into a new space, the growth space, because I'd always maintained that I thought Warren was a wonderful growth investor. He just understood how to value. I mean, if you think about Coca-Cola, Coca-Cola was a great growth company. American Express, great growth company. You could argue Wells Fargo, great growth company. On and on and on, that these weren't classic deep value stocks. These were really great franchise growth companies. And so he was a growth investor, and he was just applying a great valuation methodology to figuring out growth stocks. Working with Bill, I think, we then even expanded that. Bill led the way in the 1990s, bought Dell Computer and AOL, which was highly controversial at the time, but made a lot of money from it. In the early 2000s, we had bought Amazon, Yahoo, and eBay. We went down that path, and that made a lot of money for us. We were the largest owner of the Google IPO at the time. We controlled 10% of the IPO of Google, and even today, we bought the Groupon IPO. Hasn't worked out too well in the first few months, but we're not adverse to taking the valuation methodology and trying to apply it to innovative companies, growth companies. And so, whether today it's Rackspace, Red Hat, Jive, companies like that, Acme Packets, whatever the case may be, we're trying to use a methodology, a valuation methodology that's very solid, but apply it to companies that are going through a rapidly growing phase of growth, their growth phase, but the kind of uncertainty is very wide, right? So it's not like Coca-Cola, soda pop, pretty narrow. Something like Rackspace, Red Hat, open source software, or the cloud computing is kind of wide, right? And so the difference between what Warren is doing and what we were doing is that we basically were operating with wider cones of uncertainties, but the payoffs were going to be so much better if we got it right. So you had a wider cone of uncertainty, but if we could get the price below what our estimation was of this cone of uncertainty, wide cone of uncertainty. So, in the old days, Amazon was worth anywhere from $50 to $150 a share, and they would say, well, make up your mind, is it 50 or is it 150? Well, it's 150 if this works, and it's 50 if that works. But the more important question is where's the stock price? And the stock price is 30. You kind of go, well, that's pretty good. That's a pretty good margin of safety from our kind of uncertainty. But what happens is if you get these right, and you don't get them all right, but if you get them right, the payoffs are incredible. So, average price on Amazon is $9 a share, and the stock is $225. We've made 20 some odd times our money, and so we made 10 times on Google. We've made 9 times on Apple. So your payoffs for these uncertainties can be higher, but there's also more risk, and you have to balance that out.